Good morning, everyone. I'm happy to be in your midst. I hope everybody can hear me. Okay, happy to be in your midst this morning to talk about this topic, corporate governance and risk management. I'll be talking about leveraging of existing corporate governance practices against tax risk. We're going to be seeing how we're going to tie the two from corporate governance angle to tax risk management. The objective of my session is that at the end of the session, every participant on this training should be able to explain the concept of corporate governance, tax governance, and corporate tax risk. Also identify the elements of tax governance entrenched in the Nigerian Corporate Governance Code 2018. Be able to discuss the nexus between tax risk management and corporate governance, and then gain insight into board responsibilities in relation to tax risk management. Finally, to get familiar with tax control framework for tax compliance enhancement. Now, by way of content, I will go through a brief introduction. We'll talk a bit about corporate governance, talk about tax governance. We'll talk about corporate tax risk. We'll look a bit into the Nigerian Code of Corporate Governance and the board risk management responsibilities. What are the responsibilities that board needs to take in terms of tax risk management? Also, we'll look at corporate tax governance and sustainability reporting. What are the links between that? We'll also talk about tax compliance enhancement. What can we do at board level or at the supervisory level? We'll look at tax control framework. We'll talk about tax risk management and governance, and then we have a short conclusion for the day. Everywhere, all over the world, there is the talk about tax, unlike before. So the growing attention to tax by the stakeholders is primarily focused on the material impact tax has on financial position of companies. We all are familiar with the Enron crisis when we had corporate governance issues. Though it may not be tax specific, but these are things that can cause a company to go down beyond repair or beyond rescue. So even as it is now, we have tax issues all around. Nigeria now has been having constant review of our tax laws through the Finance Act. We have that last in 1999, and since 2019, we've gone back on track. So this is making us to know that there's more attention on tax matters. Penalty regime has been reviewed, so you can imagine penalty going as high as 1,000% above the normal regime. So this is also why a lot of stakeholders are now looking at the material impact that tax will have on their financial position before the problem arises. Stakeholders like investors, the tax administration, and other supervising bodies are also asking for a new approach to coping with tax issues. They are all looking at how do we do tax administration better. Investors are looking at what is the effective tax rate of this company I'm investing in, what are the tax benefits this person has been looking at, what are the tax risks they've been going through and they are not reporting to us, what are the likely impact of an FRS for Nigeria perspective, having an audit, and that audit runs into billions, maybe for non-compliance by the company, and that means there'll be eroding of shareholder value. The impact of tax transcends beyond complying with tax laws and regulations. Tax in current time is not only looking at do we comply with tax regulations, is now looking at what are the things we should do such that we keep strictly adhering to the tax laws without we breaching anyone, without we breaching any law, without we crossing any non-compliance threshold. So this is what we should be looking at. And if we don't drive this tax compliance at the board level, then we are likely not to get the result that is expected. It means that the risk will still be there for the company. And this will have effect at the end of the day on the shareholders' value. Now, Transparency, insight into fiscal risk, and adequately controlling this risk are becoming more and more important. I think we need to be very clear about this, that now we have to control the risk as much as possible. There are quite a lot of things happening in our fiscal environment. Laws are changing, government is reviewing some policies, and as these things are changing, there are risks associated with these fiscal policies, which are becoming more important now. We need, every company should be able to control this risk as much as possible, because there are some of the things they need to do are within their control, so they should be able to deal with this. Processes, procedures, internal controls, all are things that can be used to control the risk. This will help companies to have better understanding and control the tax risk, as well as benefit from tax opportunities. When the focus is not shifted away from looking at what are the tax risks, there will also be a way of identifying what are the tax benefits. And once these are identified, the opportunities in these benefits can be harnessed, the risk can be controlled and brought to the barest minimum, so that the company is not losing value, so that the company is not going under by virtue of tax litigation that will be so material to impact them negatively. Companies need to demonstrate to stakeholders like the audit committee, the management, the tax authorities, that they are in control of their tax issues. This is only when they can have less pressure from the tax authorities. So this is why we are in this session today. Let me first of all start by looking at this word, corporate governance. By virtue of the fact that we have ICSAN members on this call, we know corporate we know corporate governance is what we are all familiar with. And that is the whole essence of ensuring that the companies are run properly. The whole essence to be sure that we are giving, board members are giving good accounts to all the respective stakeholders, and that the company is run in a transparent, in a reasonable and responsible manner. Corporate governance is the system of rules, practices, and processes by which a firm is directed or controlled. A company is controlled, and it essentially involves balancing the interests of all the stakeholders. There are so many of them. We have the shareholders on one side, we have the management executives, we have the customers, we have the suppliers, we have financiers, we have the government, we have even the community. How are we ensuring that all these different stakeholders, their interest is protected? How are we ensuring that in the bid of running the business or running the company, we are not losing sight of the fact that all the stakeholders are affected one way or the other? For instance, the shareholders are putting their money into the company and they are looking forward to good returns. Are we managing in such a way that the shareholders at the end of the day don't regret their investment in that company? Senior management executives, they are there to run the affairs of the company in a reasonable manner, in a responsible manner, such that the shareholders are comfortable that, yes, we have left this company in the hands of good people. The customers, they want to get the products, they want to provide services, they want to get services. Are we considering the impact of what we're giving them as an entity in whatever we do? The suppliers, they are the ones that are giving us our inputs. Are we considering the impact of what we are doing on them? The financiers, not all companies will be able to run with the investment from the shareholders. Depending on the type of project, there may be need to go to bankers are there. We have other financiers are there. The government, and we're talking about tax. So the government has a stake in the business. In fact, for our information, the government is a secure creditor. Whatever happens to the company, the government needs to be paid. They take their payment first, and then the other shareholders are the ones that are at the last end. So we need to balance the requirement. The community, they cannot be ignored. If there's unrest, no company can move forward. When we are having unrest in different locations, every company in that location will be at standstill. So we still need to look at what is the community doing and how do our business impact on them. And that's what we are talking on when we say corporate governance. It's all about this. Corporate governance provides the framework for attaining a company's objectives. Your company's objective, you're into manufacturing and you want to sell your goods. Your objective is to sell your goods to the public, make your money, and also have return for shareholders. Now, what you're selling to the public, are you ensuring that it's not hazardous, it's not adverse to their health, it's something that will benefit them? Are you doing your quality checks? These are all what comes under corporate governance framework. Corporate governance encompasses practically every sphere of management, from your action plans and internal controls to performance management and corporate disclosures. Now, disclosures are even very, very on a high scale, that you have to disclose a lot about what is happening within the company. Transparency is now being enforced one way or the other. We have the Corporate Governance Code 2018, which is trying to say the way we should run, the principles that should be adopted by companies to ensure that they are doing what they're supposed to do and all the stakeholders' interests are being carried on. And tax is part of it. So when we're talking about corporate governance without considering tax risk management, it leaves us with a question on how can an issue that might encourage a corporate reorganization or influence the payment of dividend to shareholders, or which might affect a merger or takeover, possibly stand out of the boardroom. In fact, when you look at tax attributes, you could come into a merger because you can see some tax benefits in it. When you talk about reorganization of the organization, probably due to some things going on, you see, for tax purposes, this is not useful again. Let's change the way we do things. It could be staff salary restructuring because of the tax changes in the tax laws. So these are things that should be in the front burner of the board. We talk about dividend to shareholders. What are the new tax legislation that is going to affect dividend distribution? These are things that should be a boardroom issue and not be left out in the boardroom. In fact, tax is now becoming an elephant in the boardroom because before we know, it's so big and it's overwhelming everybody. Now, what is tax governance? Tax governance means having clear controls and processes within an organization's corporate governance framework to support tax decision making and manage tax and super risk that relates to tax. In fact, when you look at the transfer pricing regime we have now, they will fall under the super risk because we look at a lot of things. We don't even consider that dealing with directors to company will come under transfer pricing. It will. We don't even look at shareholder to company comes under transfer pricing. It will. It's until when there's an audit and these transactions are being unbundled by the tax authorities that we start saying, oh, wow, this risk is high. But when we consider tax governance in coming up with the corporate governance framework, we'll put these things in the purview because we look at the different laws, how they impact the business, the impact they're going to have on the way we relate with each other, related party transactions, interested party transactions, and all this. These are all the things that we consider and the controls we put in place to ensure that they don't create a high level risk that the company cannot manage when it crystallizes. Tax governance is effective when the organization's controls, processes, and risk management framework consistently result in correct tax outcomes and ensuring tax obligations are met. This is so clear. What are we trying to achieve? We want to ensure that tax returns are filed by due date, not later than due date. We want to ensure that tax payment is correct and correctly done. If you pay state tax into federal tax, you're on your own because you will go through a whole lot of process for one tax authority to be able to credit the other. If you pay Lagos into Ogun State, it's a problem. So why don't you have processes in place so that there are checks and balances as you process the payment and this error will not happen. If you file VAT returns late, there are penalties. Why don't you put in processes in place such that your VAT returns are prepared and filed ahead of the due date, which gives you a plus than filing a day after the due date is a minus because you are going to have penalty for failure to file. Now it's stricter, it's more, it's so high in the first instance and then subsequently as it continues. So this is necessary because the controls and processes for managing the tax risk needs to be embedded in the corporate governance framework. Tax governance helps the organization to steer, manage, and oversee tax from strategy to auditable reporting. At the strategic level, you must identify what must be done and what must not be done, the do's and don'ts of tax compliance, the do's and don'ts of transactions between the company and the third party, the do's and don'ts of transactions between the company and related parties, such that you don't bring up any tax issue that will become a risk that the company cannot manage at the end of the day. Or it will even be something that becomes a cash flow issue for the company. Tax governance helps to efficiently and responsibly address the fundamental change in the outside world. Currently, a lot is happening in tax environments. Globally, tax is changing. So we don't sit back and say we are in Nigeria. No, we have to follow what is changing in the global world. And we cannot do that without looking at what are the current regulations, what are the changes in the law. Before now, up until 2012, we were not giving consideration to transfer pricing. Though it's in our tax law, we're not taking it serious. But the moment the world started coming up with the base erosion and profit shifting project, we started seeing changes all over the world, and Nigeria became part of the whole gamut. So it's something that helps to efficiently and responsibly look at these changes, address them, and have controls in place to manage them. It also shows accountability on an organizational tax approach to stakeholders. We must be seen to do what we say we do. We must not say and don't do. This is what we're saying. If we say we are an organization that do this, we should be seen and it should be demonstrated in the way we report, in the way we deal with our stakeholders. Good corporate tax governance is increasingly becoming a theme that boards are expected to include in their corporate governance framework. There's no way we can leave tax governance outside the boardroom. It has to be one of the board issues to be discussed because of the impact that it will have on the whole activities of the company, as well as the effect on shareholder value. Now, let's look at corporate tax risk, because we're talking about tax risk. We've looked at corporate governance, we've looked at tax governance. The tax risk aspect of it, how does it affect this whole thing? Corporate tax risk, we have the risk associated with corporate responsibility, and it is categorized into reputational risk, regime or regulatory risk, financial or investor risk. On the reputational risk side, it would be bad if they put in the newspaper, ABC conglomerate has defaulted in paying taxes, and by so doing, the directors will be arrested. Everybody that knows ABC will run around and say, what happened? They will want to be following the trend. It's so bad now that we even have social media. They put somebody on Twitter, they will retweet and retweet and retweet. Or they put you on Facebook, the whole world will read it. So that reputation is a major issue. And once the reputation is spoiled, to redeem it takes a lot. So the best is to avoid that reputation being spoiled. This is the risk resulting from non-compliance with tax legislation. Risk mitigating factors for this include, for example, consulting external tax advisors that can guide in what you want to do so that you don't fall into any reputation risk or you don't do something that will be against the law. And also having what we call a tax control framework. We'll discuss that as we go along. The second one is the regime or regulatory risk. This is the risk associated with companies that operate globally. They operate across borders and are subject to different countries' taxation, which can be amended or differently interpreted. We see that in Nigeria happening now. We have cases in court that is coming from out of interpretation of even our domestic tax laws, not to talk of people that now operate across different countries. At the regime side, the regime risk side, you can have our tax laws interpreted one way, based on my understanding of the literal meaning, and the administrator will say, no, this is what it means because we are the one that understands the intention behind what we put in the law. That is a risk that can crystallize on the regulatory side. It includes risk of changing tax legislation. We are now having Finance Act 2019. Now, some things in Finance Act 2019 change in Finance Act 2020. If the company does not have good tax control framework or tax risk management framework, then it becomes difficult for them to identify these changes that has happened and to quickly adjust and switch to the new Finance Act 2020. This could adversely affect the company's performance. And there's also the risk of double taxation and other risks related to transfer pricing. So the regulatory risk and regime risk is wider. It goes beyond the domestic environment to other countries, to businesses that are across borders, to relationships that are across borders. For instance, we have significant economic presence in our current tax law. The impact of this is that if you're a non-resident company, you're doing something in Nigeria, you have to check, have you triggered significant economic presence by virtue of your activities? If you do not check, and that happens, the person that has subsisting contract in Nigeria will be the one that will suffer it most, and there'll be an issue. And this significant economic presence is happening everywhere, not only in Nigeria. So there's need to have this understanding, and this is a risk that needs to be prevented from crystallizing as much as possible. Financial and investor risk. People have put down their money. They have supported the company. They expect return. If they don't, if tax is not well taken care of, the return may be below what they expect. We are talking about risk, tax accounting risk that relates to inability to utilize deferred tax assets or relating to the value of loss carried forward. Now, for an investor, if you have attributes, loss carried forward, deferred tax assets are tax attributes that are useful. But there must be an understanding of how does this affect the investor's return. And this comes from the angle of tax accounting. How did you report your deferred tax? How did you record it? How did you account for it? Have you taken care of all the items that have timing differences that could result into an asset or a liability? Because the deferred tax liability will reduce the bottom line on the face of the POL. It will reduce the profit available for sharing to shareholders. If you have a deferred tax asset, you have to also be careful realizing those assets, saying that, no, I'm writing it back to income. You need to look at the potential of future profit. You need to look, so many things have to be considered. So this is something that needs to be considered. So you don't just look at tax from the operational angle alone. You look at the accounting, you look at the regulations, you look at the reputation, you look at the impact on the society and impact on the stakeholders. So that is when you can have a complete review of your tax risk. Now, let me quickly go into our Nigerian Code of Corporate Governance 2018. I'll just pick just a few parts of it that relates to what we're discussing, rather than just going into everything. Now, we know corporate scandals happen, Enron, WorldCom, the collapse of corporations in other countries. Nigeria was not left out. We have the banking problems. So that has made it clear that a transparent governance system needs to be set up by the board of every company. There needs to be some transparency around how the company is being run. And this is also emphasized in our Nigerian Code of Corporate Governance 2018. The Corporate Governance 2018 seeks to institutionalize corporate governance best practices in Nigerian companies and also promotes public awareness of essential corporate values and ethical practices that will enhance the integrity of the business environment. We are trying to ensure that if anybody sees a Nigerian company, you will not see them as, no, Nigerian company, I can't go there. But we want to ensure that anybody that sees a Nigerian company, with our code of corporate governance, you can also see the essential corporate values and the ethical practices that that company undertakes in, the transparency around it, the reporting that is being made, and the knowledge that investors have about the company. The board has responsibilities for oversight or risk management strategies, availability of risk management policies and framework through its audit and or risk management committee. And this is in the Nigerian Code of Corporate Governance 2018 under principle 11.5.6. Inside risk management strategy is also tax risk management. So as far as this code is concerned, the board must ensure that whatever risk management strategy is put in place, tax risk management strategy is embedded inside it. Tax risk management is an integral part of risk management oversight function of the board. Also, within our corporate governance code, the board has responsibility to ensure the establishment of a sound framework for managing risk and ensuring an effective internal control system is in place for achieving the strategic objective of the company. This is in Principle 17 of our code. And what this means is that you don't just say we have it, the framework must be sound, there must be effective internal control to track, to ensure that this is done, to test that these controls are in place, and to be sure that they are working. To achieve this, the board needs to articulate, implement, and review the company's internal control systems to strengthen the risk management framework. And this is in Principle 17.4 of the code. Stakeholders are showing increasing interest in obtaining comprehensive information on how tax risk management and corporate conduct are implemented and supervised. The code has made it clear, and that means that every stakeholders, they want to know, how are you managing your tax risk? How are you conducting yourself with respect to tax payment? Because it's expected that out of the tax payment, government should be able to provide the amenities required for the citizens. And your show of your contribution by being a compliant corporate citizen needs to be reported, needs to be transparent, needs to be one of the things that the board will ensure. This can be achieved with the existence of an effective internal audit function to provide assurance to the board on the effectiveness of the governance, risk management, and internal control system. And this is in Principle 18 of our code. So I've just tried to say, in all that I've said, in all that I've extracted from the code, that risk management is one of the responsibilities of the board to ensure that is put under control, and tax risk is an integral part of that. Let me look from the point of sustainability. Quite a lot of now we are talking more about sustainability. Sustainability is a global initiative, and now Nigeria is not left behind. Quite a number of our companies are now doing their sustainability reporting. How does this affect corporate tax governance? The rule of the lower the tax charge, the better, adopted for measurement of companies' performance, is gradually changing. Because of what? Because the value of tax avoidance strategies in relation to potential damage to reputation is increasingly given due consideration. What value are you getting for doing tax avoidance that makes the whole world to label the organization as a tax evader? And anywhere their name goes, they target tax evader. What is the planning around that? What is the benefit around that? A lot of people are now looking beyond just having a low effective tax rate to, are we running things in an efficient, tax efficient manner? Company stakeholders now demand for sufficient long-term information on how tax risks are being controlled, the tax risk management system is implemented, and the corporate conduct is supervised. And it is the board that has to make sure that they have to make sure that this happened. So with this, board has responsibility for that sustainability reporting to the populace, how they are doing. Now, responding to information needs of investors and stakeholders. The Global Reporting Initiative, DIR, published the GR 207 Tax 2019 Standards for Tax Transparency. And what does this try to say? It enables companies to report country by country tax payments alongside their management approach to tax. How are you managing your tax? Are you complying? Are you operating in more than one country? If you're operating in more than one country, how have you been complying with the tax rules in that place? What are the things you've done? Have you been paying your taxes regularly? Have you been paying penalties consistently? And this is a way to now look at you and say, how transparent are you on tax matters? Do you have your tax control framework? Do you have a tax management strategy? Do you have a documented tax processes and things like that? The standard supports transparency on the tax contribution companies make to the economies in which they operate. The GRS standard aligns with Principle 28 of our Nigerian Code of Corporate Governance Code 2018 that requires the board to provide full and comprehensive disclosure of all matters, material to investors and stakeholders. and ensure proper monitoring of its implementation, which engenders good corporate governance practice. So, whether we like it or not, sustainability reporting will keep continuing as organizations expand, and this will be required that every company should report how good they are at ensuring sustainability of the environment where they operate. Tax compliance enhancements. We have to comply. The law is there. We have to be seen, we have to demonstrate it, and we have to comply. How can this be enhanced? Legislative requirements as regards internal control system have increased significantly, as well as other initiatives for governmental and non-governmental bodies. In fact, you see so many states coming on tax collection, revenue generation, local government, revenue generation. Even those who are not states, who are not local government, they still talk about revenue generation. So, and in the bid of this, it means that companies must have good internal control systems that will now be able to ensure that we know what to pay, when to pay, how to pay, where to pay, and also ensure that we're not paying the wrong thing to the wrong post and to the wrong people. This is necessary. As a result of the increased attention of stakeholders to tax risk, company boards need to be familiar with the concepts, horizontal supervision, compliance agreement, and tax control framework. These concepts actually are necessary because it makes the board to understand how do the taxman see the company, how can they work together such that at the end of the day, the company is not losing, the government is not losing, and the company can stand shoulder to say, when it comes to tax matters, we are on board. We are there. We don't have to run away. We don't have to worry. We don't have to sleep with one eye closed. We know what we're doing and we are doing it well. What does horizontal supervision mean? It means that the company and the tax administration approach each other differently. Let me tell us a common one. The tax authorities believe that taxpayers lie. They will not be open. And the company believes that tax authorities just want to collect money. So they are looking at each other differently. Therefore, effectiveness of their relationship is in on trust, transparency, and mutual respect. This is the tripod. There must be that trust. If I go to the tax and I say, take it from me, this is my tax liability. I have checked everything, and to the best of my own knowledge, I file a self-assessment. I expect the tax administrators to take that from me. If they have any concern or any issue that they are trying to confirm, they should be able to also give me that respect that I would come to them, I will resolve it, and we'll both align. I hope everybody can hear me. Hello, sorry, I'm trying to check. Can everybody hear me? Hello, can everybody hear me?
Yes, ma'am, we can hear you. We can hear you.
Okay, just want to be sure. Okay, thanks. So that is where we are talking about horizontal supervision. It ends up with a compliance agreement that when we are both on the same level, that look, we trust each other, we are transparent to each other, and we have respect for each other, then we can now come to an agreement that how do we move forward? And this compliance agreement is in line with the recent developments in relation to corporate governance. We don't want to hide anything, but we want to do it right. So maybe let us move. You move small, we move small. We join at the middle. Okay, I've not done this way because I didn't have an understanding. You also want to, okay, what can you give up for the purpose of we being able to align with the requirements? And that agreement needs to happen so that there will be that trust, so that we will not be under pressure, under suspect at every time. The compliance agreement is the outcome of horizontal supervision and provides specification about the cooperation expected between both the company and the tax administration. There are times that you can actually approach your tax authorities to say, we're planning to do a transaction, and we know that from the tax law, this is what it says. And as far as we are concerned, this is what our interpretation is. Are we correct? If you go to the tax authorities, it's expected that under mutual trust, the tax authorities should be open to say, okay, though you are interpreting it to be this is our own position, and this is where we're taking this position. And the two parties should be able to iron out, because tax authority does not understand industry, they may not have full understanding of the working of the business while they are trying to collect revenue. So when this agreement is there, it's easy to understand how the other man is thinking, and the impact of the action of one against the other. This will facilitate, to facilitate the compliance agreement. Tax administration expects the company to have in place an adequate tax control framework. If tax audit is to be done, and you take them through your control, your process, that you ensure that you don't file the default, you ensure that you do the right thing, you do your checks, you do your confirmation before you go ahead to do your transactions, and they can test this. They may not even do so much in auditing that company. And that's what we call risk-based audit. Check your risk. How low is it? If it is a low risk, just check compliance and you move forward. Concentrate effort on the ones that are high risk. So anyone that has a low risk will reduce, there'll be less pressure on audits and all these pressures on submission of documents and everything. Since we know the control framework is working and we can rely on it because of their tax processes. Or making frantic efforts to implement. Once you see that, okay, we don't have this framework, but we are planning to put this in place. This is what we have done so far. These are our processes. This is our tax policy. We are working according to this. The intention to do the right thing is there. Then I think from the tax authorities' angle, the expectation is that it will be a low-risk taxpayer for them, and they will not concentrate effort in going through substantive or doing so much of test of audit, but more of checking continued compliance. Tax control framework, which is the third that I will talk about. I've talked about the horizontal supervision. This has significantly increased the focus of stakeholders on tax control framework. Thus, all companies are facing the reality that being in control of tax is essential for good business operation. See, I must be sincere with you. When you are in control of your tax matters, you'll be able to identify the operations. In fact, let me say that a tax person within an organization should be the best person to understand the business operation, because at every point in the business operation, there are tax elements. Let me give us an example. Your vendor, you want to buy from vendors. There is withholding tax that you must deduct. There is VAT they must charge. You need to have that understanding. You want to engage a foreign vendor. That foreign vendor is not here. But in our tax law, they says if you have a foreign vendor dealing with you, you are the one that will be the agent of collection of the government of the VAT. You must ensure that that is done. So when you are in control of tax, you are understanding the business, and it makes you to have a good business operation, because you would have identified the tax points, you would have put in controls to address tax at each of the points, and then you'll be able to run your business successfully. A tax control framework is a set of processes and internal control procedures ensuring that a company's tax risks are known and controlled. This is an important means to manage an organization's overall tax matters. Please, let me tell you that when you have a tax control framework, you will know your risk points. You will be able to identify what your risks are. You'll be able to identify how to manage the risk. You'll be able to identify where somebody is dropping the ball. In principle, tax control frameworks include all taxes applying to an organization, from corporate tax, payroll tax, VAT, stamp duty, every applicable taxes, informational technology tax, everything. Whether it's due to the state, federal, or due to the local government, where appropriate, and also be incorporated into the framework. So once you identify them, put them in, the complete, accurate, and timely submission of tax returns and payment of assessment is also within that scope. Because if you fail to submit on time, there's penalty. If you fail to pay on time, there's penalty, so you can't leave them out. Transfer pricing compliance is also within that scope. The tax control framework is an integral part of an overarching business control framework. When you are looking at your own business, how do I control it? Production losses, how do we control it? Sales, how do we control our sales customers so they don't run away? You know, you cannot remove tax. It must be part of that control framework. The audit approach of tax authorities is largely determined by the manner in which a company controls its tax and other processes. Tax authorities tend to evaluate the design, implementation, and effectiveness of your control framework. Once they are okay with it, they will likely not give so much pressure on the tax audit, and it will be seamless. A logical starting point for creating a good tax control framework is the COSO model for internal control framework, which is an international standard for setting up internal control system and used by many countries for the creation of their business control framework. A tax control framework enables a company to achieve its operational and financial tax goals and to implement its tax strategy in a manageable and controllable manner. A tax control framework helps a company communicate clearly about tax issues with all its external and internal stakeholders. So critical to our discussion this morning is the tax control framework, which will give you all about your tax processes, your tax procedures, your tax risk, and how you control, manage, and ensure you are within the compliance network of the tax laws. This is what I call the COSO framework. This is by the Committee of Sponsoring Organizations of the Tradeway Commission, COSO. This is used, this is a framework that you can use to set up your internal control model, and it talks about your control environment. The organization, how do they demonstrate commitment to integrity and ethical values? The board demonstrates independence from management. They just do supervisory. You look at your risk assessment. What are your risks? Identify your tax risk. What are the trigger points? Then you look at your control activity. What are the activities you put in place to manage this risk? Then from there, you look at information and communication. Who should do what? When should they do what? Communicate that. Let you know who is doing what and at what level. Then you have your monitoring. How do you check that these controls are working? How do you check that this communication is effective? How do you check that all these activities are going on seamlessly? And everything should work hand in hand, right from your overall company level to your division level to the operational level to even to the function like tax function, finance function, procurement function, business strategy function. All of them must identify the individual control. The tax elements in each of these should also be identified, and that should form the basis for the control framework. What are board responsibilities for good corporate tax governance? The first, establishment of a formalized tax control framework endorsed by the board. Once the board has approved something, who is management not to implement it? Once the board has said this is what you should do, who are the staff to say they will not comply? That will not happen because the board drives the organization. Existence of a formalized executive management roles and responsibilities, preferably a director level for tax risk management. The size of the company determines who will be at this level. If you have a company where tax is a major risk and is a large company, it is worth having a direct tax director who will make sure that from the point of view of initiation of transaction to the point of view of execution, tax risks are identified, managed, and they are controlled. Establishment of tax risk committee or allocation of oversight of tax risk to an independent board subcommittee such as audit risk committee. Part of what they can do may be supervising the tax risk, ensuring that there are processes in place, there's control in place, and the controls are tested, they are working, and there are no surprises from tax angle. Inclusion of review of tax risk in board or subcommittee charters. It's something that the board should be interested in, not until when the risk crystallizes. That's when they will now say, we are not aware. Submission of regular summarized progress updates to the board or subcommittee on how tax issues and risks are trending. Are they high? If they are high, what have we put in place to manage them, to deal with them, to control them, to remove them? Are they medium? Are they low? If they are low, okay, how do we ensure that they don't rise, they don't change from being low? How do we even eliminate them so that they don't arise? Existence of tax risk registers and escalation of issues where appropriate is necessary. What are our risks? VAT, non-filing, non-registering, this one, withholding tax, non-deduction, non-remittance. And then we say, how have we complied? That register will show January we complied, February we did not comply. Penalty that will come is this amount. February non-compliance, is still not complying up until that. So the department that is anchoring that particular transaction has to now be put on radar to ensure that they bring down that risk from high to low and minimize that penalty or even eliminate it. Inclusion of tax risk management in annual report through a statement from the board attesting to the existence of effective policies and processes to manage tax risk is necessary. It could be a small one, it could be just a few lines, but it's necessary so that the company can show that they have good corporate governance, tax governance in place. Availability of a testing plan to determine the effectiveness of tax control framework and reports from independent assurance providers on the effectiveness of the tax control framework. Why would you have a framework that is not working? If you don't test it, you will not know. You must test it, how effective it is. Get assurance from external assurance providers also, apart from the internal audit, because the external auditors will review part of the internal audit report so they can corroborate. And when they corroborate, the board has confidence that everything is under control. Now, let me now look at tax risk management and governance. We've talked about tax risk, we've talked about governance, tax governance. There's a model that is being used globally everywhere, and it's been a model that is very effective. The model of tax risk management and governance guide is as provided by the Australian Tax Office. The Australian Tax Office, they try to guide taxpayers. Their own is not to collect money. They will guide you. They will tell you what to do, put this in place. So when they come, it will even be easy for them to audit the company and to be easy for the company to track its tax risk and be a compliant organization. So they provide that guidance, and a lot of people have been leveraging on that to be able to set up their own internal control framework for tax purposes. The guidance has been a reference point as best practice. I want to say that anywhere we want to do something, we should look for the best practice. The best practice will be leveraged on and will be modified to suit our own purpose. It provides for board and managerial level responsibility for enhancement of tax compliance by companies. Due to the recent events in the global taxation environment, there's an increasing view that tax risk management should be part of good corporate governance. It should be specifically stated. The presence and testing of the tax internal control framework are an integral part of risk assessment protocols used by the tax authorities. They will look at your risk assessment. Therefore, the board needs to have assurance through the internal audit function on the effectiveness and efficiency of the company's internal control systems to meet this expectation. And that's in principle 18.5.4 of our corporate governance code, the Nigerian Corporate Governance Code. What are the pertinent questions to ask? Are the board members aware of their responsibility for tax risk management? What impact does tax risk management have on corporate structures, processes, and transactions? What qualification do the board need to actually understand and govern tax risk? If I must answer you, I will tell you, they don't need anything but to understand what the basic things are and to have good people that understand the technicalities and can interpret it to them. What exactly does the board need to do to implement a tax management system? It's not far-fetched. The processes of each company have tax risks. That is the essence of having a tax function. That is the essence of having a tax manager. That's the essence of having a tax advisor who can now tell you what are the things you need to put in place, and then the board supporting this, having policies around this to drive the risk management system. What communication and documentation requirements need to be fulfilled? This is very clear. The tax laws are very clear. They are specific. External advisors can shed more light on that. And this can be put into black and white, documented for the company to run. What kind of future development needs to be considered? A lot of things are happening, whether at the organizational level, or at the tax compliance level, or at tax authorities level, or at international tax level. A lot are happening, and they will continue to happen. So the board needs to have people in management that knows what is happening, knows the future developments, knows the future of taxation across the world, and how it will impact on the business of the company, both now and later, and give board the guidance. Tax issues are complex, multifaceted, subject to ongoing change. We've seen it, Finance Act 2019, now Finance Act 2020, everything changed again. Finance Act 2021 is on the line. Internationally, things are changing. Transfer pricing, country by country, significant economic presence, and everything. So many things are just coming up. But it requires somebody understand the technicalities to be able to quickly say, this is how it will affect my organization, and putting in the processes in place. Every business is different. Thus, there is no one-size-fits-all approach to tax governance. You need to look at your organization. What fits you may not fit the other person. What is your size? Small, medium, large. There are different things that will work for each one. The above implies that tax governance arrangements will look different for each business. In conclusion, over the years, tax planning, compliance, and risk management have traditionally been thought of as matters to be handled by the finance team. It is changing. With the change in taxation landscape and the much more attention being focused on tax in the public arena, company executives and boards should ensure that tax risk management is part of their corporate governance framework. Globally, tax authorities are leaving the path of performing elaborate tax audits as in past years and are increasingly turning to current tax issues. How are you managing your tax? Do you have control in place? Are the controls working? What is your tax strategy? They will look at that. If they can get comfort and they can see that the tax you are paying is the proper tax you should pay, they will reduce their pressure and go for those who think they are dodging and running away. The new approach adopted by tax authorities is shared and promoted by the Organization for Economic Cooperation and Development, OECD. The OECD has been supporting a lot of tax authorities. And because they saw the gaps in tax collection, people are running around, invading, they're trying to close the gaps. So they've been supporting. And the guidelines we're using, even for our transfer pricing, all these things are coming from them. And we most likely be sustained as the tax authorities across the globe implement their multilateral agreements. This was signed I think in 2016, we have multilateral agreement signed. Over 100 countries have signed that agreement. And that has to do with how we run our business. In fact, that is what brought the common reporting standards to come up, where banks, financial institutions have to now report on their customers to the tax authorities, their financial flows. Theoretically, tax management is part of corporate governance system, and therefore it is the responsibility of the whole board. Now, permit me to close by saying, global market forces will sort out those companies that do not have sound corporate governance and think that tax can be put in the background. And this was by Lord Mervyn King. That's the former governor of the Bank of England. Thank you very much.
Thank you very much, Dr. Titi Fowonkan, for that insightful, deep, and very, very interesting presentation. You have made us to know that we need to keep abreast with changes in taxation globally. We've also drawn our attention to the provision of the 2018 Nigerian Code of Corporate Governance as it relates to tax management, to also guide our listeners, and also the issue of sustainability reporting and best practices generally. Thank you once again for that wonderful presentation. I know that our listeners and participants have all benefited tremendously from this presentation. Now, our dear participants, if you have any question, please signify by raising your hand or using the chat box. So if you have any question, please, let's have it quickly so that we can bring this section to an end. Any question from any participant, please do that via the chat box or reaction button. Thank you. So we'll wait and see if we have anybody with a question or anyone who is raising his or her hand on this wonderful topic. Anybody? Okay, so Mr. Shofola Osho is commending Dr. Fowonkan for that presentation. Then someone is asking, okay, someone is saying excellent presentation, professional majesty, more glorious years
I think I
ahead.
can see a question on
Okay,
transfer pricing methodology.
okay.
How do we have framework on transfer pricing methodology? I will want to say that transfer pricing is technical, but it's possible to have a framework. It requires, number one, identifying your related party transactions. Ordinarily, under finance, there is what we call intercompany reconciliation. And the intercompany reconciliation must reconcile balances and transactions. If you are able to start from there, you already started creating your transfer pricing methodology framework. When you do that, you now know that what are the intercompany transactions. When you identify your intercompany transactions, maybe purchases of services, purchases of goods, transfer of goods, intangible royalty, use of software, shared service, identify all the different intercompany transactions. Now, the area of methodology will now be the economics aspect, because there's a special tool that you'll be able to use to determine what and what. The TP regulation has specified some methodology. There's need for you to get an external advisor to guide you if you're not the type that can read, because quite a lot of us, someone like me, I do read a lot about some of these things. So if you are telling me something as my advisor, I'm already asking you questions based on my understanding of what I expect you to tell me. So if you are the type that can read, you can have your first level identification of your controls before you now get your external advisor to confirm, corroborate, or to give you proper guidance to run you through. I must tell you that you cannot do the TP methodology framework alone. You need the support of an expert, and an external tax advisor should be able to do. But you can do the preliminary, identifying your transactions, identifying your balances, ensuring that your finance reconcile their balances, and you can start from there, because you need to know these transactions before you can have your TP methodology benchmarked against each of the transactions.
Thank you very much.
Yeah.
But you can take the next.
The questions are coming in. Okay. From Shofolawe, could you kindly clarify the implication of transactions between directors and companies as regards transfer pricing? Now, under the Nigerian transfer pricing regulation, directors and the company are seen as connected taxable persons. Now, what does connected taxable persons mean? As long as the director can influence the company and the company can influence the director, they are connected. And the company is taxable. The director is also taxable, either by way of collecting dividend from the company, he will pay withholding tax, or either by way of filing his own income tax returns. So they are connected. For transfer pricing purposes, any transaction between the director and the share and the company has to be reported in the transfer pricing returns. There are two returns: the transfer pricing disclosure and the transfer pricing declaration. The disclosure form will say all the different relationships. The declaration will say all the different transactions and what you have done, how much you've collected, how much you have paid, income side, expenses side, loan, purchases, sales, and things like that. It's very elaborate. So once you are related, in fact, transaction between the director's children and the company will fall under connected taxable persons. So that is that wide when it comes to transfer pricing. So it's expected that whatever the director will do with the company will be the same way. He will do that same thing with unrelated, non-related companies, with companies that it doesn't have anything with. That is the cross of transfer pricing. The transaction must be at terms, conditions, and price that you will deal with anyone you don't know. That is the whole essence. The other question that I have is on how does government on our part as the recipient of taxes, entrench principle of corporate governance so that the taxpayers will see the return on their compliance? This is a very good question, and I've been hearing this question everywhere I go. The first thing is this: the government has used the tax laws to hold all of us. But I always say that there's a social contract theory. The taxpayers also expect the government to also fulfill their social contract, though not in a law, but by virtue of the relationship that existed between the citizens and the government is expected to provide what they promise to provide. And that's where the social contract comes in. I know a lot of things are being done at the government angle. The single treasury account was all because of to ensure transparency, to ensure government funds are safeguarded. The Finance Act 2020 has also put in, amended the Fiscal Responsibility Act that now talks about how the legislatures and everything, how they're going to go through the expenditure approval. It has also amended the Public Procurement Act that regulates how expenditure of the public sector will be done. I think a level of corporate governance is being entrenched in these amendments to the Act. We cannot but say that we look forward to positive changes. But we as citizens, when we fulfill our part at our different groups, different opportunities, ICSAN as a body, CITN as a body, should be able to also hold government accountable under the social contract theory. That is much I can say on this. But I know that with the recent amendments to the Finance Act and everything, they have addressed they are addressing some of these issues that we raised on accountability of government. The next question in my question is, how do you apply these principles of corporate governance on tax for entities that are owner-owned, poor structure, and accounting system? Most times, no competent staff. With this weak structure, the business is expanding and throwing up all the tax risk. Thank you for this question. In fact, small companies will suffer this that you're talking about. I want to admonish ICSAN to run a session of corporate governance for small companies. They can take it as another session because there are a lot to speak on these small companies. When you are starting as a small company, you need to, first of all, be disciplined. You need to have virtue and values for integrity, ethical practices, and transparency. So for any company that is just coming, and I know the Financial Reporting Council, they're actually working on having a corporate governance code for private and small companies. I know they are doing something because what they have now will be more tailored towards the public enterprises, but it could be adopted for the private institution. The first thing is for those companies to look for how to have good accounting system. They don't need to have elaborate accounting system. There are quite a number of small accounting systems that will even bring some formality into what they do. They have to start from there. Then they also need to look at minimum structure. At least for any company, if you are any small company or any business enterprise, the owner is separate from the company. Though it may be difficult, but it is easy, it is possible. And how can that be done? I'm talking out of experience of people that I know have tried to do this. You need trusted hands. It takes God, let me put it that. You need trusted hands to stand in between the owner and the who will be doing their work. There must be clear defined goals. There must be clear defined job responsibilities. And this must be checked and tested. So I think the owner has to make up their mind to see themselves as distinct from their business and to see themselves as creating value for the people that are they are providing these business activities to. So I would want to say from that angle, they can start. The principles are so simple. Ensure you are ethical. Ethical means do what you know your power can carry. Don't do what is under the carpet, because the end of the day, it may haunt you and may kill you finally, and your business will collapse. If you are not able to carry the big logs, carry the small logs, start small, grow big. That's what I always say. Don't start big, and then you can't cope, and then you collapse. The little income that come in, manage your expenses. Don't spend more than what you can get. I don't want to go into details of the small company, because that's not what we are talking about today. But I believe it is possible.